As a dividend investor, the last thing you want to see from any stock in your portfolio is a dividend cut. In today's episode, we're going to run through 5 stocks that we see a potential for a dividend cut looming over the next few months. Now, we're going to take the dividend safety score of anything below 40 or 40 and under. As we can see, this signals an unsafe score. Anything below essentially 20, we can see a very unsafe score. So today's episode, we're going to pick 5 of these stocks. We're going to see why they look to be unsafe, the issues around them. We're going to start off the first one with Walgreens. As always, we will look at each of these companies' historical performance. We'll then look at their dividend safety score. We'll look at the financial metrics that do support this safe or in fact very unsafe score. And we will run them through the valuation model so we can understand, based on a dividend cut, what is the intrinsic value, what is our acceptable buy price, and what do Wall Street forecast? Do they also believe a dividend cut is coming, and is their forecast lower, showing zero upside or even negative? Now, before we jump into the first stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this, as well as all the other articles, do click on that pinned comment and you will get instant access completely free. So the first stock that we are looking at is Walgreens Boots Alliance. Now, they are down 36% over the last year. They haven't had the best of last years or even over the last 10 years, as we're about to see. And we can also see they are trading right there towards their 52-week low. With a forward yield of 4.61%, we are going to touch upon the fact that they did recently cut their dividend already. And we can see a forward PE sitting of 6.63. Now, if you've been a shareholder over the last 10 years, you will see you will be down 67%. Although if you do factor in dividends reinvested, it would be slightly better. However, still a negative performance. Now, in terms of the dividend safety score, and do remember this is more of an educational video today, we want to show you why we see an unsafe or very unsafe score, the reasons behind this, and the supporting metrics. So for Walgreens, we see an unsafe score of 30, market cap sitting at 18.7 billion, so it is still a large cap company. Now, in terms of the last recession, effectively they did increase that dividend, as we can see 0709. They had above average growth at plus 5.6%, and they did beat the S&P negative 44%, as we can see the S&P returned negative 55%. Now, in terms of dividend growth, they did in fact cut the dividend by negative 48% in January, so just a few months ago. And yes, this is talking about an unsafe dividend score even after the initial dividend cut we have seen in January. Over the last 5 years, they have increased the dividend by 3%. That is below the 4% we advocate on the channel, just to keep up in line with inflation. Although over the last 20 years, on average, it has gone up double digits, which is okay to see. It would be positive with the typical companies, but given the share price has taken a hammering over the last few years, it isn't something that we can really be proud of. In terms of consecutive increases, no surprise there, given that dividend cut, it does stand at 0. Now, in terms of dividend yield theory, typically it shows a company is undervalued when the current yield sits above that 5-year average. So based on that information, you could argue reasonable valuation, although slight undervaluation. But again, you can also see that on this site themselves, they do say that this essentially appears speculative, especially after that massive dividend cut that they saw and an expected dividend cut from this unsafe dividend healthy score. Forward P, well, it sits at 6 currently, below the 5-year average of 8.7, and we can see it is significantly lower than consumer staples of 20.3. Now, in terms of the free cash flow payout, remember this is very, very important, and this is something that we need to explain. We never really look at the earnings data due to the fact that it is susceptible to manipulation by management through accounting. And one of the reasons we want to point out, very important, you would have missed this 2023 spike if you were to look at the earnings. We can see earnings at 48%. If you were to have seen this, you would have noted that in 2023, management paid out a lot more in dividends than they generated in free cash flow. Now, 2024, in a more positive note, it is expected to be reduced down to 45%, which is a lot more healthy. Personally, I want to see below 60%. If you want to be industry specific, for consumer retails, that sits below 40%. Now, in terms of the free cash flow per share, not great news to note that not only is it inconsistent, but it has been decreasing over the last 10 years, and 2024 expected to 23 is an increase from 2023, but still lower than the previous year of 2022. In terms of the sales growth, well, typically on the channel, steady moderate growth, 3 to 7%. Very inconsistent over the longer term. We do note, however, in 2023, they did manage to get in between that at 5%. And numerically speaking, over the longer term, they have increased their top line from 76 billion to 139. In terms of the shares outstanding, well, positive for shareholders. They have been doing share buybacks, returning that excess cash, essentially giving you a larger portion of the company that you invest in or that you hold, reducing it from 965 million to 863. In terms of the ROIC figure on the right, above 17%, that is quite high, and that is for consumer retailers. Personally, 10% or more for me, so it gives me faith that management are able to effectively allocate their capital. Red flag indicator straight away. Not only has it been decreasing, but over the last 4 years, we see it's not even in the double digits, 3% in the more recent year, so a bit of a worry in my opinion. Operating margin, that is very, very poor. We see not just operational inefficiency due to the fact that it has been decreasing, but we also see it hasn't once touched above that 10% level that we ideally like to see. The same can be said for the free cash flow margin, as we see it has been decreasing, 0% in fact in 2023. Now, one of the most important factors for the dividend safety, and this also correlates to balance sheet strength, is the net debt to EBITDA, the earnings before the interest, tax, depreciation and amortization. Now we can see we want it below 3, the preference for consumer retailers. It's rarely been below 3, 3.7 in 2023, expected there or thereabouts in 2024. So we can see it is relatively high, and it is one of the reasons, alongside that very, very high free cash flow payout in 2023, of why there is an expectation that Walgreens may cut their dividend again in 2024, as they have already done once in January. Now again, we just go based off this information. Now let's jump into the Walgreens stock valuation. As always, if you do enjoy the content, values being provided, smash that like button. It really helps the channel. Hit that subscribe and bell button so you are continually notified of these videos as they drop. Now typically on the channel, we do run through each one, a model in fact, when we do our deep dives. Today's we want to run through a few stocks, so let's get straight into the intrinsic value. Today's episode for Walgreens, that comes to around $21.26. Now, given the current price, which is a few cents higher, as we can see, there is 0% margin of safety. If we were to even put in 5%, we can see it wouldn't be a buy till $20.20, indicating a sell. So right now we see Walgreens trading at its intrinsic value. In terms of Wall Street, well, they believe the share price will go up to around $25, so they see upside of 14%. As always, we're just here to portray the information that we see, whether or not we believe a dividend cut is coming, and we are just telling you so you can then make your own decisions based on this information. And as always, we're interested to hear your thoughts for each stock, whether or not you agree a dividend cut is coming, and whether or not you believe, in fact, it may be undervalued. Now, moving on to the next stock, we have one that we have talked about quite some time on the channel, MPW Medical Properties Trust. Now, this is down 37% over the last year and has also recently have a dividend cut, which we can come on to. It is trading towards the 52-week low, or to the lower end, and it does offer a yield, of very high yield, in fact, of 12.55%, with a P to FFO forward-looking of 4.04. This is different than the traditional companies where we look at the PE due to the fact that it is a REIT, a real estate investment trust. Now we have the lowest score, one of the lowest scores on today's episode, with 20, very unsafe. Market cap 2.82 billion, indicating a mid-cap company. Now, in terms of the recessionary metrics, well, they cut the dividend during the 07-09 crash. They had above average growth, -5 versus the S&P's -12, and they significantly trailed with their -76% recession return. So they have had, in fact, a dividend cut last summer, -48%, and on average over the last 10 years, the dividend has increased, however, by 1%, again below inflation. We can therefore see 0 years of consecutive increases. Now again, when we do look at dividend yield theory, we can see the note here that it does appear to be speculative, but we can see in relation to the 5-year average, it is much higher at 12.77, and the forward P to FO is much, much lower at 4.9, and also lower than the real estate sector P to FO at 13.9. In terms of the free cash flow payout, well, for REITs, a lot more volatile, so we don't tend to look at this. We draw your attention to the adjusted funds from operation payout. below 95% for medical building REITs, and we can see in fact over the longer term it has been pretty much below that nearly every year. 2024 at 64%, which is looking very strong. So in terms of the adjusted funds from operation per share growth, we can see inconsistencies across the board. In fact, it has been decreasing over the last 10 years, and 2024 expected to be pretty much in line with the previous year. In terms of percentage format, then we can see over the last 10 years, 4 of those years negative, with the most notable one in 2023. Next year expected a negative 20% drop. And sales growth, well, 5 to 10% for REITs. We can see 2023, nearly half of their top line has been reduced. If you want to know more about this company in detail, we have done many episodes running through the issues that we see, so do go check those out. Numerically speaking, then, you can see a bit of a roller coaster over the last 10 years, although we see from 2014 from 315 million to 886. And this is essentially really typical for REITs. They issue equity to fund property acquisitions, and therefore they essentially dilute your position over the longer term. As we always note, some REITs will dilute your position at a quicker rate than others. ROIC for REITs, I want to see 3 to 5%. We see 2023 at 1%, looking very low and a red flag indicator, similar to Walgreens that we did mention earlier today. In terms of the operating margin, actually pretty healthy from 2014 to 2022, but we do note the huge drop in 2023 to 11%, something that if I was a shareholder, I would be taking a look at their quarterly earnings as well as the annual report. Now, one of the reasons why we do believe that there will be another dividend cut, even though they had one in summer last year, is the fact that for the net debt to EBITDA, we want to see below 6, because we're being specific for medical building REITs. For other REITs, we look at 5.5. 14.27, that should send the alarm bells ringing in 2023. Yes, even though they are bringing that lower or expected in 2024, 9.69 is still very, very high, and it is something that I would say you should consider in your analysis, as well as looking and factoring that into your MOS margin of safety level. Don't forget, you can also grab a copy of this essential valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio, and those on your watch list by clicking on the pinned comment below. So margin of safety, we typically use 10%, and we use that for stocks that we like if they meet 3 criteria: the wide moat, the strong financial metrics, and good forward-looking data. We can see for MPW, we don't see a 10% MOS level. At 5%, we see it's pretty much thereabouts. So for today's episode, we give Medical Properties Trust a 5% MOS level. Wall Street, well, they see upside of 2% over the next 12 months. And as always, do let me know your thoughts. This isn't to say that a dividend cut is definitely coming. However, based on the information, this is what we are deducing. But as always, lots of different thoughts are essentially welcomed. The next stock that we are looking at, it is Leggett & Platt, LEG. Now, this is one that is right there towards their 52-week low. It also offers a very high yield at 9.6% and a forward P of 16.51, down 38% over the last year. Over the last 10 years, down 41.3%. Now, we have a 30 score here, so unsafe, market cap 2.56 billion, a mid-cap company. Now, in terms of those key recessionary metrics, well, they did in fact increase the dividend. They had below average growth, and they slightly outperformed the S&P with a negative 44% return. In fact, not the worst dividend growth. They've had an above inflationary increase pretty much in summer last year, or early summer in May 23. In the last 5 years, 4%. Last 20 years, 6%. So actually not the worst. And we can see they are in fact a dividend king with 52 years of consecutive increases. Now again, we have another appears speculative increase, or in fact, in terms of dividend yield theory, the reason for the speculativeness of these company, or when they mention this, is due to the fact that they do not believe it to be sustainable, which is effectively the most important thing. Now we see the yield higher than the 5-year average, and we see the forward P pretty much in line with the rolling 16.8, and we do know it is not too far off consumer discretionary of 15.1. Free cash flow payout, well, we can see 2021 it was much higher. In fact, since then it has come down. 2023 at 65% isn't actually the worst, so that is a positive for investors. In terms of the free cash flow per share, well, pretty uneven, inconsistent over the period. You really want to be seeing growth over the longer term as a bare minimum, even if it is small growth year on year, something just to make a note of. In terms of sales growth, well, 3 of the last 10 years it was negative, notably in 2023 at 8%, And over the longer term, whilst it has increased, as we always say, if you do factor inflation of 4% every year, it doesn't show massive signs of growth to their top line. And whilst they have done share buybacks over the year, very minimal, buying back around 7 million worth of shares. When we take a look at the ROIC, similar to the majority of these companies that we do see a dividend cut incoming, the ROIC is decreasing, although with LEG we do note even a 9% in 2023 isn't the worst that an investor could ask for, especially if a company is going through a tough time and you believe it can turn around. Operating margin below the 12%, in fact decreasing, so operational inefficiency 7%, not a very red alarm bell ringing, but again something just to be aware of. You do want to see this turn back up towards the 10% or 12% levels. Free cash flow margin, not the worst, in fact above the minimums that we look for, so that does look to be healthy. Now, net debt to EBITDA, one of the reasons for this essential dividend cut thesis, or in terms of the worry that is there, it has been increasing over the longer term, and whilst it is above that in 2023 marginally, 2024 the trend is upwards to 3.51, so definitely something to consider. It could be a very real possibility, especially when you consider how high that yield is, touching 10%. In terms of the valuation, well, for today's episode, LEG is coming to a total of $22 and the current price at $19. When we put in a 10% MOS level, we see it is around that. At 15%, it isn't quite there yet, so we see 10 to 15%. Now, typically for companies that do show a lot of risk, personally, I would be looking for a much larger margin of safety, at a minimum 25%, but again, this will be different depending on each investor. We also see Wall Street are forecasting $20 over the next 12 months with upside of 4%. The next stock that we are taking a look at, it is Rio Tinto Group. Now this one is down 3.5% over the last year. Over the last 10 years, however, it is positive, up 26.1%. All-time highs around $91. Bear in mind this is a fairly cyclical company, and we see it is towards the lower end of the 52-week range. Another very high yield at 8.1% and a forward PE of just above 8. Dividend safety score, well, 40 unsafe, market cap 109 billion. It is a mega cap company. Now, just because, as we're about to find out with Rio Tinto, companies do look like a dividend cut is inbound, it doesn't necessarily mean it is a bad thing that the company shouldn't be bought or that it isn't undervalued. Now, key recessionary metrics, they cut the dividend in 07-09, they had below average growth, and they also trailed the S&P negative 71%. Now, as we see here, negative 11% over the last full year, 8% over the last 5 years, and over the last 20 years, 10% double digits. And we can see here 0 years of consecutive increases, a certain theme among some of these stocks. Now, when we take a look, again, appears speculative. Essentially, there isn't that faith that management will be able to sustain this high yield for quite a long time. We can see the essential yield is sitting slightly above the 5-year average, and the forward P isn't too far off. When we compare it to the materials sector P, it is much higher at 20.6. Now, in terms of the free cash flow payout, we can see it is an increasing trend. For mining companies such as Rio Tinto, we want to see 40% ideally. So this is one of the reasons why the alarm bell should be ringing. It is increasing, and 89% is expected in 2024, something you wouldn't be able to deduce from looking at the earnings. Now, in terms of the free cash flow payout, it has increased over the long term, very inconsistent, although this is a very cyclical business. Something to bear in mind, 2024 expected to reduce slightly as well to 486, and we can see the cyclicality with 5 of the last years in negative growth. Numerically speaking then, 47.7 billion to 54 billion, and they have also been doing some share buybacks, which is nice to shareholders, so something just to note there. ROIC actually very high, and in fact for mining companies you do reduce it to around 8 to 9%, so to see it in double digits for the majority of the last 10 years is very positive. Margins as well looking very healthy, both on the operating side, both on the free cash flow margin side, so nothing really to note there. Net debt to EBITDA as well looking very healthy, as we can see 0.25 in 2023, 0.23 expected in 2024. So there are 1 or 2 red flag indicators from this company, but overall it does seem to be one of the better companies that we do expect a dividend cut to come. And as we mentioned, it doesn't necessarily mean they are uninvestable companies, and if you do buy them at the right price and essentially with a nice margin of safety, it could be a very strong choice for the portfolio. So margin of safety, we start off with 10% for Rio Tinto. We see a buy up to $71.52. 15% still showing a buy, 20% pretty much around the current trading price. So we see a 20% MOS level. In terms of Wall Street, well, they believe there to be 25% upside with this company. So again, dividend cuts don't necessarily mean negative things for businesses. And we can see just under $80. In fact, Wall Street do believe it to be around what we have calculated as our intrinsic value in today's episode. We then move on to the next company, which is Omega Healthcare Investors. Now, this is actually up 19% over the last year, and we can see a downward trend and down 7% over the last 10 years. It is trading in the mid to upper end of the 52-week range, with again another high yield of 8.5%, with a P to FFO of 11.6. Again, this is a real estate investment trust. Now we can see here, in fact, dividend safety score 40, it does look unsafe, and the market cap just under 8 billion, making it a mid-cap company. Now in terms of the recessionary metrics, while they maintained the dividend, we can see they had plus 2% sales, and they significantly outperformed the S&P 500, and they haven't had a dividend growth since 2019, although on average, if you've been holding it for the last 20 years, it would be up 11%. And hence we can see 0 years of consecutive increases. However, they have been paying a dividend for the last 20 years without a reduction. Again, another appears speculative, no faith in being able to maintain that yield for a long time. And we can see it isn't too far off the 5-year average on both the yield as well as the forward P to AFFO. It's also slightly lower than real estate sector at 13.9. Now, in terms of the adjusted funds from operation, you'll start to see why we see that dividend cut incoming. In fact, over 100% this year in 2023's full year and expected in 2024. And we can see we want to see below 80% for senior living REITs, which Omega Healthcare is. So that's our first warning where the alarm bells are going off. Second one is minimal growth in the adjusted funds from operation over the longer term. No growth expected in 2024. And we can see here 3 or 4, in fact, of the last 10 years, negative adjusted funds from operations growth, and 3 of the last 10 years in terms of negative growth to their sales. Numerically speaking, though, they have increased their top line from 505 million to 950, and as we mentioned with REITs, very typical for them to essentially dilute your position as a shareholder. ROIC, though, looking fairly healthy on this metric alone, but we never look at metrics in isolation, as we do want 3 to 5%. 2023, 6% looking very healthy. Operating margin, again, not too bad either, even though it is decreasing. 51% in the more recent year is looking favorable. And finally, the net debt to EBITDA, another area alongside the payout ratio, which does send some warnings to investors, is that we want below 4.5 for senior living REITs. And although it has decreased from 2022, it still is above that 4.5 level. And we can see 5.04 expected in 2024. So now we get to the valuation of this REIT OHI. We can see the intrinsic value is arriving at $33. And with a current price of $31.67, we can see it doesn't have a 10% MOS level. It has around a 5% based on the current value. In terms of Wall Street, well, they believe 1% upside with a price target of $32.10 in today's episode, forward looking for the next year. As always, though, do let us know your thoughts in the comments below. Are you buying any of these companies? Do you also believe they could be dividend cuts coming imminently in 2024? Or are these ones that maybe you are buying and believe that if a dividend cut does happen, then the share price will increase like we have seen with some notable stocks in the S&P 500? As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see each and every one of you on the next one.